Hello, welcome back again. Stock market has been ripping yesterday. Went up at some point, I believe, like 3% on the Nasdaq, which is absolutely insane. But you would kind of expect this kind of move when the stock market reverses course, really, or it's about to. Now, that doesn't mean it won't come back with a vengeance and actually go down again. This kind of happens a little bit when you have this kind of bearish market sentiment, but it's a good positive sign towards potential positivity for the future and switch to our normal bullish circumstances currently. Now, in this channel, I have been talking about buying value and buying good companies and good stocks when the stock market is down and when these stocks are down. And so the very previous video that I made about Alibaba was about buying it just because it crashed. And not only just because it crashed, and it's making tons of money. It's actually a fantastic company in terms of what kind of money they're making. Because you can talk about all these political situations with the US and China and all the extra rules that the US is posing to Chinese stocks and pretty much all the IPOs. And you can dig very, very deeply into these things. But in the very end, this kind of sentiment and these kinds of discussions tend to dissipate after some time passes and nothing really happens. The only thing that happens is that the company goes back to normal in terms of how it's perceived by investors, and so it starts gaining value back. And this is what I wanted to point out in this video, and also show you a few things about what the company is doing in terms of some other metrics here, like profitability, enterprise value, and things of that sort. And also, I was reading this very, very interesting video here, which I very, very much agree with, that Alibaba cash position reflects 25% of its market cap, yes. And it kind of discusses that the cash from operations has increased almost tenfold since the IPO, now surpassing 30 billion per annum. The cash per annum has increased more than tenfold since 2013, from 5.3 billion to more than 70 billion. And so you're looking at a company that was trading at, let's say, around $100. I still remember the IPO. It was around there, $100 back in 2013. And since then, it has increased tenfold, and it's trading at almost the same price. That doesn't make a lot of sense, does it? It really doesn't, and this is why we want to be examining Alibaba for a potential addition to our portfolio. I myself have bought Alibaba about a month ago, and I'm thinking of buying more, actually. But before we continue with this video, please take a look at our Discord channel. You can find a link in the description below. You may want to join us. And if you haven't subscribed, please do so, because there's gonna be a lot more videos about Alibaba and other companies that are very, very interesting and very trendy this day. Next up, I'm planning to create a video for NIO and Tesla and all the big companies. Facebook also is a very interesting one. So stay tuned, and I'd love to see you subscribe here. So. You will see here that this is one of the times where the market is in manic depressive mode, hence the great bargain offered to us. And the article basically goes and describes in detail some information about how valuable the brand is, obviously, and some revenue information in terms of the price of the stock and all that, how low it has gone and what is its current market cap. But we can examine these things also as well. And some very, very interesting thing to see here. The return on equity over here actually used to be a little bit higher than what it is today. However, return to equity, although used a lot, it can be a little bit deceiving because how much debt you have can actually propel that value and make it better looking, even though it's not really. So it's not, while it's a useful metric, it's not the end all be all, and it's good to know about it, but in some situations, you can find a very, very high return to equity just because the company is getting a lot of debt, and you have to be careful about that. So 11% right now is a very, very fair 11.25, very, very fair, very fair over return on equity over here, and it pays to examine how much debt the company has as well, which you can see is very, very low, and so that kind of affects potentially negatively the return over here, and so the return on equity. And so, again, bear that in mind. You may be watching a company that has like a 25% return on equity, yet it has so much debt because it gets a lot more risk to actually increase the value of that return on equity because a lot of stockholders sometimes falsely look at this value. So although it's useful to know about, and 11% with this kind of data, I think it's very, very good, especially when when getting on an S&P 500 ETF gives you 10% every year. So I think that's very, very fair. And that doesn't also count the fact that the company is making tons of free cash flow here and keeps on growing very, very nicely. And you will see here another very interesting metric here. You will notice that the enterprise value of the company has been going down, and that has to do a lot with the market capitalization. The enterprise value is a little bit of a kind of a better market capitalization figure because it extracts debt, interest, and things of that sort, and gives you a number, a little bit of a more realistic number. And this enterprise value is used for multiples like the EV to sales ratio here. And so enterprise value to sales, meaning the ratio between the value of the company, the market cap minus the debt that the company has, interest and all that, divided to sales. And so a lower multiple here tells you that the company is making a lot of sales in comparison to what the company is worth, right? I mean, it's fairly obvious here. And so it used to be 13, which is pretty high, but now it's 2.3, and everything between 1 and 3 is a very, very good EV to sales ratio. And other interesting things about the company. Whoops, we have some issue here. Let me fix that and come back. Okay, I guess my router went bananas for a little while out there, so fix that, and I'm back. So you will see here that, let me find the cash flow, actually, the cash flow over here, which is super, super important, obviously. The free cash flow of the company, 2017, 10 billion, and now 24 actually, $24 billion. 2.5 times more than what it used to be in 2017. Massive, massive increase in free cash flow here. And a market cap for a company of $340 billion. And what is the multiple of that? Is like what, less than 10? Or actually, no, it's a little bit more, like 13 or so, something of that sort. And this points to a company that is making tons of money, and it's still very, very undervalued, again, based on what it's making. And again, I completely understand that you may have some fears about all this, all this information that you're getting out of China and what, being a communistic country and all that, a communist country and all that. But it used to be the case 10 years ago. That hasn't changed. It's always been like that. So I feel that there is a little bit of sort of like a situation of where there is like blood in the streets here, and a very, very interesting potential buy here. Because again, these kinds of news, they may barely affect the company. Probably they don't even affect the company at all in terms of its operations. And it does affect the sentiment of investors in the short term. But this is when a value investor hits the market and actually says, okay, I'm willing to withstand that for a little while, and I'm going to wait it out and see what's going to happen with the company in the next 5 to 6 years or 10 or more. And I've had some people in my previous video talking about how they have bought Alibaba in its highs, really. Like if you see here, and I can understand the pain. Like if you bought Alibaba, let's say 3 years ago or so, 2 years ago, you could have bought it at around these levels, 270, 250, and then be like, okay, the company has like lost 50% of its value or even more in some situations. And so you'll be like, is it a good opportunity to sell now? But think about it straight. Think about it in a more realistic fashion, and forget about the fact that you have money tied to the company. And this is why I'm always saying you should be investing with money that you don't need at all, money that you need to forget about. Because if you have invested with money that you don't need, then you won't be feeling like you have to sell. Because these kinds of downturns can happen, and can happen very many times. And I have seen it time and again, really. Companies like that going down and down and down and down, and sometimes it feels like there is no bottom. And there is a bottom, there's always a bottom, but it tends to be lower than what you think. So I wouldn't be surprised if the company actually goes back to 100 at some point. I wouldn't be surprised at all. Does that mean that I'm going to sell here? No, I'm going to buy more. Because the fundamentals of the company haven't changed. The company is making tons of money. Their financial ratios keep increasing, keep getting better every year. And so the only maybe potential thing here is that the fact that they have printed a few more stocks here, a few more shares, but that's not enough to give me trouble here and to be a cause of concern for me at all. No way. And this is a company that I'm buying for sure. And I wanted to make this video just to give you some information of what's going on with the company and how a value investor treats these kinds of situations. We don't trade the news. Trading the news is about trading. You can trade the company and suggest that it's going to go down based on what's happening with its averages, with its RSI, MCD, and all the metrics that you could be using, volume. And you can trade that this way and trade it every day or trade it every week or so. But when we're talking about long-term investments, we're looking at what the company is doing financially. This is what matters in the end. It doesn't matter how the company is moving in a year or 2 years, because again, this kind of downtrends can last for a long time, and maybe even more than a year in many situations, 2 years. I mean, the thing is, are you buying for 2 years or are you buying for 10 years? That's the very important thing. And so I would myself definitely look into buying more of Alibaba potentially, although currently I'm looking at other stocks as well, because there is some interesting stuff going on in the markets right now, and there are some potentially interesting companies to add to a portfolio, especially after that downturn. So I hope you enjoyed the video and you found it interesting. And if you did enjoy it, if you did like it, please leave a like and subscribe. And in the meantime, you can watch this one that I made about Salesforce. A similar situation here about a company that is doing well. I'm examining whether it's a good purchase, really. Thank you for watching, and I'll see you in the next one. Bye-bye.